In this simulation, China begins liquidating $3 trillion in U.S. Treasury bonds, agency debt, and dollar-denominated assets across a single week. The sale starts at 9:47 p.m. Eastern Time on a Sunday night, announced through a terse statement from the People's Bank of China. By the time New York opens Monday morning, futures markets have already moved in ways most traders have never seen. The dollar drops 4.7% against a basket of currencies in under 6 hours. Treasury yields spike 89 basis points overnight. Something fundamental in the global financial architecture has just been tested in a way it wasn't built to withstand. This isn't a gradual shift, this is a controlled detonation. The first institution to feel it is a mid-sized pension fund in Ohio, managing $18 billion in assets. Their portfolio holds a standard mix, 60% equities, 35% bonds, 5% alternatives. By Monday at 11 a.m., their bond holdings have lost 11% of their value. The fund manager sits in a conference room watching 3 monitors flicker with red. He's been in this job for 19 years. He's seen corrections. He's seen flash crashes. This feels different. The velocity is wrong. The selling pressure isn't coming from panic or sentiment. It's coming from a sovereign entity with a balance sheet larger than most economies. He picks up the phone to call the board. He doesn't know what to tell them yet. Across the hall, a compliance officer notices something in the margin call reports. Normally, margin calls arrive in predictable waves tied to volatility. This morning, they're arriving in clusters, staggered across asset classes that shouldn't be correlating. Equity futures, corporate bonds, mortgage-backed securities, currency swaps. Everything is moving in the same direction at once because everything is denominated in or tied to US dollars. She flags the report. No one responds yet. Everyone is watching the same screens. By Monday afternoon, the Federal Reserve convenes an emergency meeting. They don't announce it. The meeting happens in a secure room with no windows. 12 people sit around a table looking at projected liquidity models. The models were built for stress, but not for this kind of stress. In a typical crisis, the Fed can inject liquidity and stabilize markets because the crisis is usually domestic or sentiment-driven. This crisis is structural. A foreign central bank is actively selling, and the Fed can't simply buy everything without flooding the system with dollars and triggering inflation concerns that are already elevated. Someone suggests invoking emergency powers. Someone else suggests calling Beijing. No consensus forms. The meeting ends with a plan to reconvene at 6 a.m. Tuesday. The room felt still, but the first real sign wasn't visible yet. It appeared somewhere nobody expected. A quiet shift began forming not in the headlines or the trading floors, but in the derivatives market, specifically in the credit default swap spreads on U.S. sovereign debt. These instruments are designed to insure against default. For decades, the spread on U.S. Treasuries has hovered near zero because the idea of a U.S. default is considered impossible. Monday night, the spread jumps from 0.02% to 0.31%. It's still a tiny number, but the direction matters. Traders who specialize in tail risk start making calls. Some of them start hedging positions they've held for years without ever hedging before. Tuesday morning opens with Asia already in free fall. The Nikkei drops 6.8% in the first hour. The Hang Seng falls 7.2%. European markets open and immediately trip circuit breakers. By the time New York opens, the S&P 500 futures are down 9%, triggering a 15-minute trading halt before the bell even rings. When trading resumes at 9:45 a.m., the selling continues. Algorithmic trading systems detect the velocity and pull back, which removes liquidity, which amplifies volatility, which triggers more algorithms to pull back. It's a feedback loop. The VIX, a measure of expected volatility, hits 74. The previous record was 82 during the 2008 financial crisis. All of this still traces back to that one moment when China initiated the sell-off. Every shockwave originates from that decision. A logistics company in Tennessee starts feeling the pressure by Tuesday afternoon. They operate a fleet of 3,200 trucks moving goods across the eastern United States. Their financing model depends on short-term credit lines they roll over every 90 days. The credit is cheap because it's backed by receivables and considered low risk. Tuesday at 2:30 p.m., their bank calls. The credit line is being pulled, not reduced. Pulled. The bank cites market conditions and counterparty risk exposure. The logistics company has 72 hours to find replacement financing, or they'll have to ground trucks. The CFO starts making calls. Every lender she contacts says the same thing. Liquidity has dried up. No one is extending credit until the Treasury situation stabilizes. She doesn't know when that will be. Wednesday begins with an announcement from the Treasury Department. They're accelerating an auction schedule to absorb the sell-off. They're issuing $410 billion in new debt over the next 10 days. The announcement is meant to signal confidence. It does the opposite. Investors realize the U.S. government is now competing with itself for buyers. Yields on the 10-year Treasury hit 5.8%, the highest level in 22 years. Mortgage rates, which track Treasury yields, spiked to 9.1% overnight. Refinancing applications collapse. Home purchase applications drop 34% in a single day. Real estate agents start canceling open houses because nobody is showing up. Something else was forming quietly. A municipal bond fund in California manages infrastructure financing for schools, hospitals, and public transit. Their bonds are considered safe because they're backed by tax revenue. Wednesday afternoon, they receive redemption requests totaling $2.1 billion. Investors are pulling money out, not because the bonds are bad, but because they need liquidity. To meet the redemptions, the fund has to sell assets. But there are no buyers. Municipal bond markets operate on thin volume in normal times. In a crisis, they freeze. The fund is forced to sell at discounts of 12% to 18% below par value. This creates losses for remaining investors, which triggers more redemptions. The spiral begins. By Thursday, the conversation shifts from markets to systems. A regional bank in North Carolina with $67 billion in assets starts seeing deposit outflows. Customers aren't panicking in the traditional sense. They're not lining up outside branches. They're moving money digitally, quietly, into money market funds or foreign currency accounts. The bank's liquidity ratio drops below regulatory thresholds. They request emergency funding from the Federal Home Loan Bank. The request is approved, but the terms are steep. The bank's stock drops 41% in one trading session. Analysts start using the word contagion. This chain reaction begins from the same point, the sudden liquidation of $3 trillion in U.S. assets. Thursday night, the president addresses the nation. The speech is 8 minutes long. It emphasizes stability, cooperation, and the resilience of American markets. It does not address the underlying question everyone is asking, which is whether the U.S. can continue financing its $36 trillion debt load if foreign buyers lose confidence. The speech ends with a pledge to work with allies and partners. The markets open Friday morning down another 4%. By Friday, the damage has layered into the everyday. A family in Virginia is trying to close on a house they've been saving for. The mortgage rate they locked in 3 weeks ago is no longer available. The new rate is 9.3%. Which increases their monthly payment by $870. They can't afford it. The sale falls through. The realtor calls the seller, who was counting on the proceeds to move into assisted living. The seller now has to delay. Assisted living has a waiting list. The delay cascades. A retiree in Arizona checks her 401k balance Friday morning. It's down 23% since Monday. She's 68 years old. She was planning to retire in 5 months. The plan was built on a portfolio value of $1.4 million. It's now worth $1.08 million. She runs the numbers again. If she retires now, a manufacturing plant in Michigan produces automotive components. They export 40% of their output to Canada and Mexico. Their contracts are priced in U.S. dollars. As the dollar weakens, their foreign customers start requesting price reductions to compensate for currency losses. The plant can't reduce prices without cutting into margins that are already thin. 2 contracts are canceled Friday afternoon. The plant manager schedules a meeting for Monday to discuss potential layoffs. Every consequence you're seeing originates from that exact decision. By Saturday, analysts start publishing estimates. The consensus is that the sell-off has erased roughly $4.7 trillion in global equity value. Bond markets have lost $1.2 trillion in value. Currency markets have seen swings larger than any period outside of wartime. The dollar has stabilized somewhat, but it's 6.3% weaker than it was Sunday night. Import prices are rising. Gasoline is up 0.41 per gallon in some regions. Grocery costs are climbing because many goods are imported or rely on imported components. Inflation, which had been moderating, is now expected to accelerate again. The Federal Reserve meets again Saturday evening. This time, the discussion is more focused. They decide to intervene directly in the Treasury market, purchasing $300 billion in bonds over the next 2 weeks to provide a floor under prices. It's a form of quantitative easing, a tool they've used before, but this time it's not about stimulating growth. It's about preventing collapse. The announcement comes Sunday morning. Markets react with cautious optimism. Futures climb 2.1% in early trading. But the optimism is fragile. Sunday afternoon, a second statement is released. This one is joint from the U.S. Treasury, the Federal Reserve, and the European Central Bank. It announces coordinated currency swap lines to provide liquidity in dollars for foreign institutions. It's a signal that the problem is global, not just American. The statement is careful. It avoids the word crisis. It uses terms like volatility and market adjustment. But the subtext is clear. The financial system is under pressure in ways it hasn't been since 2008. A data analyst in London spends Sunday evening building models. She's trying to estimate how long it would take for markets to fully absorb $3 trillion in asset sales. Her models suggest 6 to 9 months under normal conditions. But conditions aren't normal. Liquidity is thin. Risk appetite is low. Correlations are high. She adjusts her assumptions. The new estimate is 14 to 18 months. and that assumes no further shocks. She saves the file and closes her laptop. She doesn't send the report yet. She's not sure anyone wants to see it. By Monday morning, 7 days after the initial announcement, the immediate panic has subsided. Markets are no longer in free fall. Treasury yields have stabilized around 5.3%. Equity markets are down roughly 18% from their pre-crisis highs, but they're no longer collapsing. The VIX has dropped to 52. Trading volumes are returning to something closer to normal. But normal isn't what it was. The baseline has shifted. A faint mechanical hum vibrated behind the screens. Insurance companies start reviewing their exposure. Many hold large positions in treasuries because they're required to by regulation. The losses are manageable on paper, but they affect capital ratios. Some insurers quietly begin reducing policy offerings in certain markets. Annuity rates are adjusted upward to reflect higher yields, but also higher risk. Life insurance underwriting becomes slightly more conservative. These changes are invisible to most people. They happen in spreadsheets and actuarial tables, but they compound over time. Pension funds face harder choices. A public pension system in Illinois is underfunded by $141 billion. The losses from this week have widened the gap. The fund's board meets to discuss options. They can reduce benefits, which requires legislative approval, and will face legal challenges. They can increase contributions, which means higher taxes or reduced public services. Or they can take on more risk, investing in higher yield assets with less liquidity. There's no good option. The meeting lasts 4 hours. No decision is made. Small businesses start feeling the contraction. A restaurant owner in Oregon has been planning to open a second location. She had a small business loan approved in principle 3 weeks ago. The bank calls Monday afternoon. The loan is no longer available. Lending standards have tightened. The bank needs to conserve capital. She asks when she can reapply. The banker says he doesn't know. She cancels the lease she was negotiating. The landlord, who was counting on that rent, now has to adjust his own budget. He delays a planned renovation on another property. The contractor who was hired for that renovation loses the job. Monday evening, a think tank in Washington publishes a paper analyzing the structural implications. The conclusion is that the U.S. fiscal model, which has relied on foreign buyers absorbing roughly 30% of new debt issuance, is now facing a confidence gap. If foreign demand remains weak, the Treasury will have to offer higher yields to attract domestic buyers. Higher yields mean higher interest costs. The U.S. already spends over $1 trillion per year on interest payments. If yields remain elevated, that number could reach $1.5 trillion within 2 years. That's more than the defense budget. The paper is technical. It doesn't predict collapse. It simply maps out the mathematics of an unsustainable trajectory. All of this still traces back to that one moment. By Tuesday, 10 days after the initial announcement, a few patterns have clarified. Foreign central banks other than China have not joined the sell-off. Japan, the second largest holder of U.S. treasuries, has issued a statement affirming its commitment to U.S. assets. The European Central Bank has done the same. This provides some stability, but the damage is already embedded. Risk premiums have repriced. The cost of capital has increased across the economy. Credit is tighter. Investment is slower. Hiring plans are being reconsidered. A venture capital firm in San Francisco holds an internal review. They manage $4.2 billion across 87 portfolio companies. 15 of those companies were planning to raise new funding rounds in the next 6 months. The firm decides to delay or cancel 12 of those rounds. The companies will have to extend runways by cutting costs. That means layoffs. One company, a logistics software startup, lays off 34% of its staff on Wednesday. The employees receive severance, but the job market has changed. Tech hiring has frozen. Some of them will be unemployed for months. The data seemed to settle. Then a second layer appeared. A credit rating agency downgrades the U.S. sovereign debt outlook from stable to negative. It's not a downgrade of the rating itself, just the outlook, but it's symbolic. The statement cites increased fiscal pressures and reduced foreign demand for U.S. assets. The Treasury Department releases a response calling the move premature and not reflective of underlying economic fundamentals. But the market has already moved. Yields tick up another 11 basis points. 2 weeks after the initial announcement, the immediate crisis has passed. But the world has changed in subtle, durable ways. A mechanical engineer in Ohio who was planning to buy a new car decides to wait. A couple in Texas who were considering starting a family decides to delay. A small manufacturer in Wisconsin who was going to hire 3 new workers decides to hire 1. These decisions are individual, but they aggregate. Consumer spending slows. Business investment slows. The economy begins to decelerate. A graduate student in economics writes a thesis analyzing the event. She argues that the real cost wasn't the market losses, which will eventually recover. The real cost was the loss of certainty. For decades, U.S. Treasury bonds were considered the safest asset in the world. They were the foundation of global finance. Pension funds, insurance companies, central banks, and sovereign wealth funds all held them as the bedrock of their portfolios. That certainty has now been questioned. Even if markets stabilize, even if yields come down, the psychological shift remains. Trust, once fractured, is difficult to fully restore. 3 weeks after the event, life has resumed a surface-level normalcy. Markets are trading. Banks are open. People are going to work. But beneath that surface, the adjustments continue. A county in Pennsylvania delays a planned infrastructure project because financing costs are too high. A university in Massachusetts freezes salaries because its endowment has lost value. A hospital in Florida reduces staff because reimbursement rates haven't kept pace with rising costs, which have been amplified by currency weakness and inflation. The numbers looked stable until they didn't. A portfolio manager in New York reflects on the event during a quiet afternoon. He's been in finance for 31 years. He's managed money through Black Monday, the dot-com crash, the financial crisis, the pandemic. He's learned that markets are resilient, that they recover, that fear eventually gives way to greed. But he's also learned that some events change the rules. This was one of them. The assumption that the U.S. could borrow indefinitely at low rates, that foreign buyers would always be there, that the dollar's reserve status was untouchable. Those assumptions are now conditional. They depend on confidence, and confidence, he realizes, is more fragile than the models suggest. He closes his laptop. The sun is setting over Manhattan. The skyline looks the same as it did 3 weeks ago. But something has shifted. Not loudly, not dramatically, but unmistakably. If a moment like this ever reached where you live, if the systems you rely on without thinking, credit, savings, employment, the value of your currency, began to move in ways they weren't supposed to, what would it mean for you?